Welcome back to First Things First. Today, I'm going to talk a little bit about managing the emotions of investing. So if I drew this graph here, a hypothetical stock market illustration, if we were to look and say when would be the best times to invest and when would be the best times to sell, most people would probably agree that that looks like a pretty good time to put money in. This one, that one, all sort of market bottoms. And then if we said if you needed to get money out, when would be the appropriate time to sell? We'd say, well, in an ideal world, we could sell, here and here. And those would be right. Those are right answers. So the question we have is, why is that not actually what happens in the real world? See, because what the data tells us is that a lot of the money that goes into the market tends to go in, here and here. And when we see money leaving the market, most of it tends to happen down here. So why does that happen? Why, if we know that these are the right times to invest, why do we wait up here to invest money? Well, that's a great question, and I'm going to explain it to you by way of a story. Back in 2008, 2009, we all remember the financial crisis that took place in North America and actually around the world. Looking back, we can see that March 9th of 2009 was actually the bottom of the market. At the time, we didn't know it. We're living through it. And if you remember what the news headlines were like, we were hearing about, the auto industry in North America needed bailouts. Some of America's largest and longest standing companies were going broke. It was a very scary time. People were saying, this is going to make the Depression look like a walk in the park. So it was a really difficult time to be an investor. However, had you waited until the economic news got better, and the economic news did not get better till October of 2009. So from that whole period there, all we were hearing was negativity. The interesting thing though is that from March of 2009 till October of 2009, very scary economic news times, the market actually increased by over 60%. So if we were investing according to how we felt, we would say, well, I don't feel good now. I feel much better over here, which is the wrong time to invest. So you might be asking, okay, how do we look after this and what do we do about that? We'll come back next time and we're going to talk a bit about rebalancing and how we detach the emotions from investing. Thanks. We'll see you next time.